I'm sorry. Those are probably the two hardest words in the English language to say. I'm sorry. Really hard to say. If you're an active portfolio manager, or if you are in the business of hiring active portfolio managers to generate results for your clients, you really don't want to have to say those words to your clients. I'm sorry. I'm sorry I underperformed. Sorry I'm overweight emerging markets. I'm sorry I picked somebody who is underperforming. They're really, really hard words to say. And when I think about what we are focused on doing on my team, which is generating outcomes for individual investors who are saving for retirement, we think it's even more important to think about the context that we are saying I am sorry in. Now, every day when I walk to work, I take the train into Manhattan, and I walk to our offices in Midtown from Penn Station. I make a point of looking for the delivery truck of our very first target date client, who is still a client of ours today. They are a very large consumer beverage company. I can always find one of their trucks anywhere in the world. I saw one this morning actually driving to the airport on the Turnpike right next to me, an 18-wheeler. And I always think about that truck driver and think to myself, you are my client. That guy, it's almost always a guy, lugging the dolly, that crate of beverages over the curb, right? That is my client. And I was just thinking as I listened to all these explanations and conversations that we were just having today, which I found compelling. It's what I do for a living. Think about this stuff all the time. They would have no idea what we were talking about, and they don't actually care. If you think about your individual client sitting across the table from you, none of them care. My father asks me, what do you think about my portfolio performance? And I say, I don't know. What did you want the guy to do for you? Right? What outcome are you trying to achieve? So this notion that indexing never means having to say you're sorry is, I think, a very scary concept to start embracing, right? And why do we want to embrace it? Because those are such hard words to say. And I think especially when you are thinking about picking individual managers and individual asset classes, and as we've all described in US large cap equities, it's so tempting to default to this myth that means you're never having to say you're sorry. So if you buy an index manager and you're only focusing on the outcome of that asset class in that context, yep, you can say, I know exactly what you're going to get. Assuming the index manager is good, you're going to get the index minus their fee. I won't have to say I'm sorry, I'm safe. But you're not actually tying that to the outcome that your client is asking you to achieve for them. Certainly in the context of an asset allocation fund, and I will acknowledge freely that this is entirely self-serving, but when you look at the 5-year rolling returns of our 2030 fund, for instance, and look at the number of times it is in the top quartile, net of fees 100%. Outcomes are what we care about. Outcomes for a plan sponsor, outcomes for the truck driver, outcomes for your end client at the end of the day when you put all this together. Indexing means never having to say, I'm sorry. What is sorry in this case? Sorry is underperforming a benchmark. Sorry is not getting somebody to a safe and secure retirement. That's how I think about sorry. Now, when we dig under the hood a little bit and try to understand what is going on in the asset allocation world when people are indexing, our contention is that most index providers are optimizing the portfolios that they build around fees and tracking error, i.e. they're putting the most things in their portfolio that are the cheapest to index and the things that have the lowest tracking error when they index them. We did an analysis a couple years ago, and if we tried to replicate our target date glide path with Vanguard's index funds, our fees would be twice as high as Vanguard's, because the things that they don't include in their glide path and the weights that they put them in at skew wildly the cost for the end client. So we ask ourselves, is asset allocating around cost control necessarily going to get you to the right place? Is that going to mean you won't have to say I'm sorry at the end of the day? And I think that's flawed logic. Now, when we look back at what's happened, we find a pretty clear and compelling advantage, right? There's a statistical example, obviously picked carefully. Maybe not. Maybe it would be true for any of these funds. But it's not just true right now. And again, that gap of $10,000 or so that you've got over 12 years, that's nice. When you think about the truck driver, and you think about a 45-year career earning $50,000 a year, contributing 8% of that a year after year after year, we'd hope they stayed that steady, we see a small benefit from that superior asset allocation and a very large benefit from the 50 basis points that we've added for active management. Now, $71,000 after a lifetime of saving may not feel like a lot of money to the people in this room, but that $70,000, when you translate that into yearly income for that truck driver, is going to make the difference between them being able to go and see their grandchildren in person or having to Skype with them instead of seeing them in person, right? That difference is enormous. And I think when we lay next to one another, right, the argument that I think a lot of passive providers make, well, you only can count on the fees, therefore, if you can control those, you've done your job, right? You've defined away uncertainty. We think you're missing the point of only thinking about things that you can control on cost. Now, I live in the 401k world. Litigation is an ever-present conversation. And that brings me to my second myth, which we hear a lot. We hear this a lot from our clients. We hear a lot of this from the advisors that work with plan sponsors, and sometimes from the institutional consultants that work with plan sponsors. And this is the myth. If I hire somebody cheap, I won't get sued. And this myth is, I think, particularly dangerous because it goes at the heart of what it means to be a fiduciary. To be a fiduciary is to put the interests of your participants in front of your own. And there have been a series of court rulings that have, I think, rather soundly beaten this myth. This is in particular from the Ninth Court, is, I think, important. Fiduciaries have the latitude to value investment features other than price and indeed are required to do so. Now, again, I cannot tell you how many times I have had someone say, we'd like to hire you, but you're more expensive and we'll get sued. This is an absolutely frank conversation that happens. There have been lawsuits against, there's been one lawsuit that I know of against a plan sponsor who documented that they hired an index provider so they wouldn't get sued, and they got sued for that because they were not acting in the participant's best interest. They were looking after their own best interests. So again, all other things being equal, fees are incredibly important. They are not the only thing that is important. Now, I think we've heard a lot about indexing and its flaws, the way we need to think about understanding and analyzing what's going on inside of active management. This is the other myth that we hear a great deal. Well, I just want to buy the market. I want to buy the world. I just want to make sure I get everything that I need to get. And, when we think about what you're buying in the U.S. equity market, and again, I hadn't realized to what extent we were all sadly in agreement with one another, I think, on the panel. When you're buying a U.S. equity fund, you are pretty much getting the U.S. market, right? This is the sort of the biggest index of the U.S. stock market. You're getting 99% of the total market. The S&P gets 86% of the stock market, right? That's pretty good coverage, right? What about fixed income? I don't talk a lot about indexing and fixed income, but a lot of people do it. You're getting 50% of the U.S. fixed income market when you buy the AG. That leaves a lot of stuff out. And the other thing that we find very interesting when you compare what's going on inside of an index, when you're buying an S&P 500 fund, for instance, you've got the equity index. The companies who are growing inside of that index, whose price is improving, become ever larger parts of the index and you buy more and more of them. And there are moments in time when this is not a great investment strategy, but generally you want to buy more of what's doing well, and presumably their stock prices are going up because the company is being well managed and it is making good management decisions. In the fixed income index, the things that become larger and larger in the index are companies and countries and parts of the government bond sector that are issuing more debt. Generally, companies that are issuing more debt are not necessarily the companies that you want to own more and more and more of. So there's an underlying catalyst going on inside these two indices that I think many people don't understand very well. And finally, when we think about what's going on inside of the ag today compared to the pre-financial crisis, you've got a lot more stuff in there that doesn't have much or any yield. You've got almost double the amount of treasuries in the ag. You've got more corporate debt with relatively low spread that does not provide much cushion against a rising interest rate environment. And you've got a lot more duration. Duration's gone up to almost 6 from 4.5 before the financial crisis. There's very little cushion if interest rates start backing up at the sort of middle and long end of the curve. And so I think there's going to be a lot of surprises about what that market is going to do to the individual who owns it. So when I think about what we are trying to do for our clients, generate an outcome that is going to satisfy their needs and wants and desires, in my instance, helping people get safely over the finish line, get to a retirement that they want, I think a lot about not having to say I'm sorry. I think about literally the millions of people that are invested in our target date strategies. I think about that truck driver, and I think about how can I make sure I am not going to generate an outcome that you won't like, that will fail you in your retirement. But to me, we are being lazy investors and poor fiduciaries if we are not asking ourselves, how can we do everything that we can to generate the outcome that we're trying to achieve, thinking holistically about all of these factors, digging under the hood to understand what's going on, when and how, and doing everything we can, including risking saying I'm sorry. And as a last thought, right, and again, we've all been sharing data like this, saying I'm sorry when you buy an index fixed income manager, for instance, over the last 10 years, 97% of the core plus managers in investments outperformed the index. 97%. Now, that's not always going to be true in every 10-year period. It's lower in shorter time periods. But again, when we think about saying I'm sorry, right, I would be apologizing, frankly, if I own the index in that circumstance. So with that, I'd like to say thank you, and I think we're going to get ready to bring the panel up.
Thank you, Ann.